Hello and welcome back on the Easy Finance channel. In today's video we will speak about inventory accounting methods. Inventory is one of the biggest numbers on many companies' balance sheets. Yet, for most beginners, it's a mystery. How is it valued? How does it affect profits? Why do some companies use FIFO, others LIFO, and still others weighted average? In this video we will take a full journey through inventory accounting. We will define what inventory actually is, look at how it is recorded and measured, walk through the main valuation methods step by step with an example, and by the end you will be able to read a set of financial statements and immediately understand what's going on with inventory. So, let's get started. Before we get technical, let's talk about why this topic matters so much. Inventory accounting is not just a box you tick at the end of the year. It has a direct impact on cost of goods sold, the single biggest expense line for most product businesses, and therefore on gross profit, operating profit, net profit, and even taxes. Think about it. If you change how you assign cost to the goods you sell, you change your reported profits without selling a single extra unit. Investors, lenders, managers, and even tax authorities look closely at these numbers. But what counts as inventory? To understand this video better, let's first define what accountants mean when they speak about inventory. They mean something very specific. Assets that are held for sale in the ordinary course of business, or materials and supplies that will be consumed in producing goods to sell. For a manufacturing business, we normally break this into three buckets. Raw materials. These are the components you've purchased but haven't started to work on yet. Work in process, the partly finished items still on the production line. And lastly, finished goods. Finished goods are the completed products waiting to be shipped or sold. For a retailer, it's simpler. It's just the merchandise on the shelf. For a service company, there's usually little or no inventory at all, because they sell time or expertise rather than goods. This distinction is important when you compare companies across industries. Now that we have seen why inventory accounting matters, let's look at the main ways companies value their inventory. There are three primary methods you will encounter. FIFO, first in, first out. Cost of the earliest purchases flow into cost of goods sold first, leaving the newest costs in ending inventory. LIFO, last in, first out. Cost of the most recent purchases flow into cost of goods sold first, leaving older cost in ending inventory. And weighted average cost. All costs are averaged together to produce a single unit cost for both cost of goods sold and ending inventory. So, let's look at the three most common methods with a concrete example so you can really see the difference. Imagine a company buys 100 suitcases at $10 each early in the month and later buys another 100 units at $12 each. So in total they bought 200 suitcases. At the end of the month it sells 150 suitcases to customers. We have 200 suitcases available for sale, 100 at $10 and 100 at $12. Which costs go to cost of goods sold and which remain in inventory depends on the method. So we break it down in the different methods. First we start with FIFO, first in, first out. Under FIFO it is like this. The first one we bought is the first one we sell. So our 150 suitcases would consist of 100 units at $10 and 50 units at $12. Ending inventory would be the remaining 50 suitcases at $12 each, because first in, first out. Next we have the LIFO method, last in, first out. Under the LIFO it is different. Here the suitcase we bought last is the first unit we sell. In our example, the 150 units sold would be 100 suitcases at $12 and 50 suitcases at $10. So our ending inventory would be 50 suitcases at $10 each. This results in higher cost of goods sold and lower reported profit in an inflationary environment, which can also mean lower taxes. And last, the weighted average cost. Here we take the total cost of goods available. So we sum them up. 100 times the $10 plus 100 times the $12. So in total we spend $2,200 on the 200 suitcases. And now we divide it by the total units available. So 2,200 divided by 200. That gives an average cost per unit of $11. We then assign $11 to each of the 150 units sold and to each of the 50 units remaining. Weighted average is simple and smoothes out price fluctuations. Another dimension is when you update your inventory records. We distinguish here between two main methods, the periodic and the perpetual system. In a periodic system, you don't keep continuous records. Instead, you do a physical count at the end of the period and compute cost of goods sold as beginning inventory, plus purchase minus ending inventory. This is simpler but gives you no day-to-day information. In a perpetual system, you update inventory every time there's a purchase or sale. Modern point of sale and ERP systems make this easy. You can see stock levels in real time and spot shrinkage or errors quickly. Most medium and large companies use perpetual systems today. Especially with AI, it makes it a lot easier nowadays. Errors in counting or valuing inventory can distort profit. If you overstate ending inventory, you understate the cost of goods sold and overstate the profit. The next period, the error reverses. This can confuse trend analysis and even mislead investors. That's why auditors pay so much attention to inventory. From the law, companies have to disclose in the footnotes which inventory method they used. Analysts often adjust these figures to make companies comparable. Ratios like inventory turnover and days on hand show how efficient a company manages stock and how quickly it can turn inventory into cash. Finally, good inventory accounting isn't just about picking a method. It's also about strong internal controls. Regular physical counts, segregation of duties to prevent theft, reconciling records with reality, and choosing a system that fits your business model. Inventory accounting affects profit, taxes, and decision making, so it is really important. You've learned what counts as inventory, how it flows to cost of goods sold, and the major valuation methods FIFO, LIFO, and weighted average. In our next video, we will dig deeper into analyzing inventory ratios like turnover and days on hand. Don't forget to like, subscribe, and hit the bell so you don't miss anything. See you in the next video. Bye bye.